Good evening, everybody. Thank you very much for joining in. This side Rahul Magan here on behalf of Treasury Consulting LLP, and today we are going to speak about very interesting topic which is happening in the banking sector, which is the crisis in the Indian banking sector, the default which has been done by Dhanlaxmi Bank. Although Dhanlaxmi Bank is a public sector, it's not a public sector bank, it is almost controlled privately, but still we are going to take you to some very important sequences or the steps, exactly how that fraud has happened or how the Indian banking system is on the verge of crisis. As you very well understand that as per the Reserve Bank of India, sitting March 2016, the gross net non-performing assets is approximately roughly 5.84 trillion INR. If I compute in INR, this is 5,84,000. Now, one thing which we clearly need to understand that gross non-performing asset is rising every year. In fact, if we carefully see that the recently reported result by Bank of Baroda, Indian Overseas Bank and few other banks, it's proved that the mess has not yet over. Mess would continue for maybe a longer period of time, could be several years, right? We are not sure about that. And in fact, personally, I strongly believe that the number which is reported, which is 5.84 trillion INR or 5,84,000 crore is something which is absolutely wrong. It is not even 1/3 of exact position which RBI reported to the system. Now, considering this as a backdrop, today we are going to take you about very recent scandal that has happened in the Indian banking system, which is Dhanlaxmi Bank. Default done by Dhanlaxmi. This is an article which we got it from Bloomberg TV. But before starting this video, Treasury Consulting LLP would like to take an indemnification that all the figures, numbers and stuff which has been with us, that has been provided up by the media. Treasury Consulting LLP is having no role to play in any of the figures which is mentioned in the video. Everything which we have is as per the media. So we not taking any ownership of any of the numbers. Whatever we got, this is from the internet or the media. As simple as that. I have this of Bloomberg. So let me read this for you and then I'll explain this for you. In July 2016, Dhanlaxmi Bank missed an interest payment as it is failed to pay a coupon on a subordinate debt instrument according to the Fitch rating. Excellent. Fitch say that this is the first time investors in India have had to forego interest on the bank capital instrument. It has also added that failure highlighted the increased risk to the bank capital investor from mounting asset quality and deep capital adequacy pressure on the Indian banking system. But more is yet to come. Please be here. On 5th of August, the local rating agency CARE has assigned a default rating, which is of course D, to Dhanlaxmi Bank upper second tier bond, which is 27.5 crore, which we mentioned here. So Dhanlaxmi Bank issued bonds tier second, 27.5 crore at 10%. Perfect. The bank later clarified that Reserve Bank of India had advised to defer payment of the coupon which was due on 30th July and pay it later years. It was primarily because bank capital adequacy ratio as on 31st March has fallen before 9.6%. This is absolutely shocking. Absolutely shocking. First thing, you have a bank who is issuing a bond, 27.5 crore bond at the rate 10%. Now, this should have a RBI stipulated capital adequacy ratio. Pre-April, it was approximately 9% and post-April, RBI himself increased to 9.625%. So roughly increase of 62 basis points. At the time of maturity, at the time of 31st March 2016, the stipulated capital adequacy ratio was less than 9.6%. That's absolutely shocking. On the other hand, this country claiming that by 2019, all the banks would have the capital adequacy ratio as per Basel III. And in fact, if I'm not wrong, without mentioning any bank name, I myself saw on the Bloomberg TV that several banks are having more stipulated capital, even mentioned by the Basel III. I myself not sure how that can possible, and I'm not naming the bank, but I know that these banks are having mounting of non-performing asset, but still how they would be able to manage this, not sure about that. Now what had happened, they issued a bond of 27.5 crores to RBI stipulated capital adequacy ratio. Pre-April this is 9%, post-April this was 9.26%. RBI increased by 62 basis points. Now Dhanlaxmi Bank was less than regulatory level of 9.625%. And they claim that all because of the asset quality review and the higher net provision. I don't understand why asset quality review and the higher net provisions are taken into consideration. I don't understand the logic behind the same. Because of course, asset quality review and non-performing asset provisions is an integral part of financials. Every bank across the globe in Europe, US, Sweden, Denmark, London, Russia, China, Australia, Sydney, wherever, they are subject to have an asset quality review and hire and provisions for NPAs. Then why the Dhanlaxmi Bank is claiming that the capital adequacy ratio has fallen only because of same? Last but not the least, as per the latest research done by various research bodies, banks need an additional amount of 90 billion of capital by 2019 if they need to maintain a minimum capital requirement as per the Basel III. Now we would like to pose few questions to our viewers. Number one, where were the regulators when the Dhanlaxmi Bank capital adequacy ratio fallen from 9.6 fallen less than the stipulated level of 9.6%? Why Reserve Bank of India auditors not audited the books from the perspective that if the CAR capital adequacy would fall below 9.6%, then the Dhanlaxmi Bank would get an excuse not to pay an interest, and which they will pay in the later years. What is the fall of the basically wrong done by the investor who invested in this bond and they are not getting the interest? Again I repeating, who authorized Reserve Bank of India giving this that it was Reserve Bank of India Reserve Bank of India holds the power to prohibit banks from paying coupon if the capital adequacy ratio fall below the minimum requirement. In April 2016, RBI raised this minimum 9.62% from the previous 9%, increasing the risk for the bank capital investor. Who authorizes RBI to give this mandate to banks that if it is below 9.6%, then you should not pay or you should defer the interest payment? Tell me just simple one thing. So tomorrow, assuming by 2017, you will make it mandated that the capital adequacy would be 11.5%, and then you will create a law. If your CAR is less than 11.5%, then you should not pay the interest. And why this Dhanlaxmi Bank is creating a crisis in the system? Because this is not a public sector bank. We know that recently government did an recapitalization of almost 23,000 crores in Indian public sector banks. Since Dhanlaxmi Bank is not an Indian public sector bank, it is almost held in the private hands. Henceforth, this bank will subject to crash. And if this would happen, this won't good for the Indian banking system. People will lose trust in the Indian banking system, and you very well understand that what is a scenario of a global banking situation when central banks on the one side are fighting for negative interest rate, asset quality review, huge amount of loans in the books of the banks, in the books of the corporates, and last but not the least, shadow banking. On the other hand, we are here fighting for this penny issues that Indian banks do not have a adequate capital adequacy ratio, and banks are following. Last but not the least, RBI making all the norms to make sure banks don't pay the payments, but they never make the norm that why these banks are mounting up so much huge amount of non-performing asset. Even though we would appreciate the fact that the $5.84 trillion figure given by RBI is absolutely correct, but still we would like to understand very sincerely that why Reserve Bank of India, how come this $5.84 trillion of NPAs got accumulated, and of course few NPAs belongs to Dena Bank as well. How? This is not a one-day role. I must say that this must started from Subbarao, this moves to Raghuram Rajan, and this would continue even after Raghuram Rajan. This was the purpose of the video, just to highlight you that Indian banking system is moving towards a crisis. Dhanlaxmi Bank is a perfect example in that, and I would like to advise all the people who are dealing in the bank nifty to please be careful. Rest is yours call. You are welcome to contact us at treasuryconsultingllp@gmail.com. Our alternate email ID is rahulmagan8@gmail.com. Our contact number is 9899242978. It's my handheld. My mobile number is our Skype connect is Rahul5327. Thank you and have a great day.